Egypt's cabinet has raised its allocation for food subsidies by 20% and for petroleum products by 24% in the 2023-2024 fiscal year. The budget forecasts GDP growth at 4.1% and inflation at an average rate of 16% during the next fiscal year, which starts in July. Yasser Hakim has more from Cairo.
The Egyptian cabinet has approved the state budget for fiscal year 2023-2024, which begins in July till mid-2024. The newly released draft budget focuses on social welfare programs to protect its vulnerable population. Egyptians are reeling from the fallout from the conflict in Eastern Europe, which has led to record inflation rates, high external debt levels, and a currency that has been devalued 3 times in the last year, leading to a surge in prices. The 2023-2024 fiscal budget saw an increase in food subsidies by 20%, while energy subsidies jumped by 24%. Meanwhile, social welfare programs were allocated an extra 24%, and salaries and pensions are expected to climb by 15%.
If we look at the food and energy subsidies alone, they account for 10% of the total budget, and there is an increase in subsidies despite the budget deficit. Expenses are to be covered from expected high revenues of $100 billion in the next fiscal year from tourism, remittances from Egyptians abroad, and exports, which are gradually increasing.
Mohammed Atman, a father of 3 children, is shopping for his family in Egypt's capital. He says more subsidies are still needed at these tough times.
I benefit from the subsidies. Without them, I won't survive because my salary is very low. Subsidies cover part of the expenses such as buying bread, which is very important, but the subsidies are still not enough to cover the rest of our expenses.
The government has also established outlets countrywide to sell food and basic goods at lower than market price to support the predominantly poor population from the surging cost of living, which rose to a new high of 32.7% in March.
The real solution to inflation hikes, I believe, is to increase production and reduce consumption. The government is focusing on expenditure on investment projects to increase production, revenue, and employment opportunities. Secondly, to stop the devaluation of the pound, we have to increase exports because currently our imports are much higher than exports.
Cutting import bills will reduce the demand on hard currency and thus sustain the Egyptian pound from further slumps.
Experts say these issues must be addressed at a faster pace. Otherwise, inflation hikes and the devaluation of the Egyptian pound will continue to be a headache every year. Yasser Hakim for CGTN, Cairo.